hello. Welcome to the Biz Doc Podcast. I'm Tom Ellsworth, the Biz Doc. I'm here with Kylo and the charming Kelly, the Swiss Army knife, Kellyanne. And she's going to run charts, pull things up while we talk about stuff. And this is what we've got. We have 3 segments today. The first segment, Kai and I are going to run through some stats and what they mean for you. And what do we got? We got
the decline of threads.
Uh-oh.
We got consumer cash spending.
Uh-oh.
And who is overpaid, which is from a survey where they were looking at the most paid people across different industries.
Wow, that's an even bigger uh-oh. I hope that's not me.
Yeah.
And then segment number 2, we're going to go to, we have a CEO interview that we're going to be in segment number 2 today, and that will be Guy Gao, the founder and CEO of Side, which is a platform, kind of the Shopify of real estate, enabling super successful realtors to go and build their own business on their previous success and to take more profit out of that for themselves. It's incredible. I think you're going to like what he has to say because he's got stuff that apply to entrepreneurs everywhere. And then lastly,
a very interesting case study on a little-known club, Inter Miami, that is suddenly on the global stage with signing the superstar Messi. So that should be a very interesting one.
I was just about to say who plays for them, but boy, we know who plays for them now. Yeah, we have a Biz Doc case study coming up. The board is back, and the case study is back, so we're going to put that up at the end. But first, we're going to run into now some stats. The decline of threads you just talked about. What do we have?
Yep, absolutely. So the decline of threads has been very interesting. Threads came out of nowhere, copying more or less the main features that Twitter had, and a lot of people were saying, this is the Twitter killer. But after having signed, I think it was almost 100 million people they signed, now the user data is reporting that usage has dropped 43% since July 7th. So that's quite interesting. What are your thoughts on that, Tom?
Wow, this is what I think. Look, controls, you know what? Control-C, Control-V is not a way. By the way, that's for you Windows people. It's different if the
Command.
different for the Mac. It's Command.
Yep.
But you know what? That is a bad way to make a product. That is a bad way. And we know what's going on here. It's like, this will be the Twitter killer. This will be this. I signed up. I found out that I moved all my Instagram contacts. I found out I couldn't stop it, that once it was going, that I couldn't turn it off. And then I found out that there's a bunch of features missing. I felt like I had an early alpha product, like what they would say, I love the books that I recommend, 0 to 1 and the Lean Startup. They're both a little different on concepts, but there's one of them that talks a lot about the MVP, the minimum viable product. And I just didn't feel like all the features were there. What did you think when you signed?
No, absolutely. I mean, I never even signed up for Threads, but
You're the guy then. There's one missing from my Instagram.
Yeah, that's me. I'm sorry, Tom. No, but I think the biggest thing for me with Threads was that it came out of nowhere. They're trying to copy Twitter, and it's pretty obvious. There's no other additional things where it's like, wow, this is cool. It's more just, hey, we're just copy pasting this. And what happens, in my opinion, is that depending on different platforms, you have different user behaviors and consumption. And then the challenge with that is when you just move people who are on Instagram, although it's a different app, you move them over, it doesn't necessarily mean that the content is going to correlate or that the followers are going to correlate, because depending on what platform you're on, you might be consuming different content. So it's not as simple as just shifting the audience over, because what the audience that cares to look at your beautiful lifestyle with pictures and stuff like that, they might not really care about something like your thoughts or your words and stuff like that. And just because you're skilled on one platform and you can communicate or articulate yourself via pictures, via videos or something like that, doesn't mean it's going to formulate over words.
No, totally. And so the premise that what Meta made was like, okay, this is what we're going to have. We are going to basically assume that your audience on Instagram, where maybe you're selling things or tracing your lifestyle, is going to match the narrative audience that you have on Twitter, which is more of a news feed with opinion. At least that's what it is for me.
Yep.
I don't have pictures of the Biz Doc babe or Bailey the golf girl or Brooke the soccer fiend. I don't have those. Actually, she's now the swimming fish. She's reminding me she's in 2 sports and swimming is number 1. So I got to get that right.
Swimming.
Brooker, I'm sorry. But, I don't put any of them up on Twitter, and I'm very selective about what I put on Instagram because they're my kids and they're minors. But it's very different. And so So this was a study by SimilarWeb. So this is not our own research. We went out and dug into this, but what SimilarWeb is saying is that the traffic fell 43% from July 7th to now, and now is July 20th, July 21st tomorrow. So that's 2 weeks to really look at everything, not overnight stats, quick stats. That's real good sample run by a reputable company that says that's for Android, and they're also running it and currently processing now for iOS, but they're seeing similar numbers, but they're going to get their numbers straight before they announce it. But this is enough to say it showed up quick. Is it disappearing quick? We'll wait and find out, because we know it can't disappear completely because they don't let you delete it. You know?
No.
That's it.
But talking about that, something else that's been crunched now over the last couple of years here, consumer cash. This is going to be interesting. You want to pull up the chart here?
Oh, I love this. I love this chart you found on this.
Yeah, absolutely. So here we have the chart coming up here, and it basically just goes to show that the consumer spending, it's the consumer built up a cash buffer.
Isn't that it? We're looking for consumer build up a cash buffer in the pandemic, but balances have dwindled. That's what we're looking for.
Yep. So let's see. I mean, we can just discuss it as it's coming up here. I think, does this surprise you at all?
No, it doesn't. It absolutely doesn't at all. What's happened is there was just an announcement that came out. This was a new statistic that came out about a week and a half, 2 weeks ago. Talk about total credit card debt. That total credit card debt, which is on credit cards. It doesn't add up your house, doesn't add up your car, and people could say those are reasonable or unreasonable large debts, but the credit card debt is very much usually related to lifestyle.
Yep.
And that it was as low as $650, $690 at one point during the pandemic when all the checks came out from the government, the released checks. However, it then has popped up to $1 trillion. And so we heard that. Then we heard, I think it was 4 weeks ago on the PBD podcast, we covered that people said in the last 2 years that at least one time they had to go to savings or actually use a credit card to make the mortgage payment. Now, we know you can't make a mortgage payment on the credit card, and you can't take one of those convenience checks that are attached to your monthly bill if you still get a paper bill and use that. But what they do is you can get a cash advance to yourself if you have enough credit limit, and you can put that cash in your checking account, then pay your mortgage. And so the understanding was over 2 years, 1 out of 2 years, which meant that the consumer was suffering the long-term effects of inflation. Remember, inflation can go down, but the price of everything can still be high, not moderating. It's called moderation. Gas at the pump will spike, then you hear about the price of oil goes down, barrel of oil, and suddenly the gasoline moderates at the pump. That doesn't always happen with the price of eggs or other things you buy.
No, exactly. And if you're looking at the chart here, you can see that on 2020, early, obviously it spikes out of nowhere. You're going from almost, low percentages all the way up to 60%. And then the other part is it kind of drops down quickly, and then it shoots up again, which I think was round 2 of the stimulus, and then it skyrockets round 3. So I think that a correlation here is pretty interesting to see. As soon as there's more spending, obviously you have more of a cash buffer, but then when people go out and buy Gucci bags or whatever they want with that, you're not really using it for what it's worth. And then the other thing is, now that we're returning more back to normal where you're paying rent, even eviction moratoriums and stuff like that, where people weren't even getting by without paying rent and stuff like that. So I think that in the grand scheme of things, this doesn't really surprise me at all, because as we're returning to the normal, the free money, the endless printing is coming to an end, and now we're going to have to suffer the consequences of it.
Yep, and I wish we had this chart to put up. I don't know what happened there, but what it shows is, regardless of income strata in America, the inflation effect and the disposable savings effect right now was the same. That it's coming down and the consumer balances have buffered.
Yep.
Well, the third thing, if you're a consumer and you're trying to save more money, the third stat that we have here is, are you overpaid or not? Well, you're always going to answer, no, I'm not. But if you ask a bunch of workers in America, who is overpaid, they all have an opinion, don't they?
Yeah, so they did a sample of 3,000 people asking various different positions of, Are they overpaid in terms of very or somewhat overpaid to slightly overpaid, and then not sure, and then vice versa in terms of like they're underpaid or they're very underpaid. So if we pull up the chart here on this one, we can see the various positions, anywhere from politicians,
there we go,
professional athletes, CEOs, lawyers, investment bankers, to on the bottom here we see retail sales workers, restaurant workers, nurses, farmers, and factory workers. I'll let you go first on this, Tom. What are your thoughts?
What's very interesting, this is a tale of two cities. If you look at the top here, what we've got, and I'll talk over this, is politicians and professional athletes and CEOs. Everyone seems to think 76, basically 3/4 of America says, all you guys are overpaid. Now, lawyers and investment bankers, only 2/3 of America seems to think they're overpaid. But however, something I agree with, you go down to the bottom, is they believe that retail sales, restaurant workers, the list you just had, nurses, farmers, and factory workers were very or somewhat underpaid. Yeah. Isn't that interesting?
No, absolutely. And I think that the other part with these are, there's two different levels I see it in terms of, because obviously you have the argument for somebody's overpaid if they either have a skill set that's providing a lot of value or there's very few of them in a simple supply and demand. So I think the interesting part is politicians being number one, and pretty significantly in terms of that.
Nancy Pelosi, on a $200,000 salary, has accumulated almost $150 million in wealth. I think the actual number is 140.
Exactly. Huh. And the other part too, I think with this is possibly too also just a lot of people being fed up with.
Would that be overpaid or overbribed?
Who knows? Who knows? But I think they're probably, it's also a sign of just dissatisfaction in terms of how they've done the job. Of if you feel like, because it's fair, if you feel like somebody's putting in a lot of work and you're receiving a lot of reward from it, it's worth it, right? Because this goes back to perception. If the perceived value is high, you're willing to pay that value, right?
Exactly.
Apple, the iPhones are way more expensive than other phones, and they cost very little to make.
Or just great service at a restaurant. You're there for your kid's birthday, and somebody is just giving you that extra effort. That's high value. And you sit there and say, I know that this is not a giant salary thing, and they rely on tips, and so you try to take care of them.
No.
Where you can, but you can't always do that. The great nurse that helps you in an emergency room and your kid sprains their ankle, you don't give them a tip. You just hope that they're well paid, because what they're doing is such high value. They do such a good job. You walk out of there thinking, man, I'm so disappointed that nurses aren't paid more.
No, exactly. And I think the other interesting correlation here with all the five that are significantly underpaid, they're very manual intensive labor. So that's another interesting stat here. But in terms of CEOs, Tom, what do we have coming up?
Well, first of all, this is basically the stats pack for the week. The decline of threads, consumer cash crunch, and then who's unpaid, paid. And now we've got a CEO interview coming up in the next segment just now with Guy Gao of Side, and I'm really looking forward to this. We'll be right back. Okay, Biz Doc, I'm back. Second segment today. I'm really excited about this because I did a case study on this company about 2 years ago when they landed on the scene, making a disruptive difference in real estate in a very positive way. And I did the case study at the time they had become unicorn status. So we are really glad to have with us today Guy Gao, founder and CEO of Side.
Thanks for having me.
Oh, glad to be here. So I did the case study and we can read the website, but in your own words, what is Side? I've called you a platform. I've called you a difference maker. In your own words, who are you?
Well, I thought you did such a great job of profiling Side, and were one of the very few people that was right on the nose. But yeah, Side is a real estate brokerage as a service. So it's invisible, white label, real estate brokerage end to end, but it's got no brand that is consumer facing of its own. It is entirely a platform that's behind the scenes. So on top of the Side platform today, you'll have hundreds and hundreds of boutique real estate agencies that are actually owned by the agents who provide the service to that community. And here behind me on my virtual background, you can see many hundreds of them.
That's fantastic. What I thought was really interesting about what you did is there are so many things that a realtor does, but the number one thing is make relationships with buyers and sellers, and you can't automate that. Someone has to know their neighborhood, know their part of the town, high end, low end, through soccer teams, moms and dads getting ready to buy houses, or through high end experiences at a country club. You got to know your people. But beyond that, there's so many things that can be automated that can make that energy putting into the relationships so much better. And I thought that what you had done was incredible and really, really innovative. What was your inspiration to say, you know what, real estate needs a platform so all these things can be done for the realtors so they can work on relationships and buy and sell and spend the maximum amount of their time making transactions?
Well, first I'll say this, which is not related directly to your question, but I'm going to get right back to it. Is that early on, our key insight was that everyone that was looking to build and innovate within real estate was trying to automate away the agent. And our realization was that you can't really automate away someone who deals in nuance and who services folks in that way. But what was something that seemed like an opportunity for automation was the brokerage operation and infrastructure itself, because brokerage is in effect a clearinghouse that is manually managed on an office per office basis. And Side is the ACH equivalent to that at our core. That's what we do from a technology standpoint. So you're absolutely right, as usual, about that. But the inspiration for Side wasn't born out of an interest for us to automate something that was being done manually. Rather, it was born out of the fact that we recognized that you had this subset of agents that were already running their own businesses, that were incredibly committed full-time fiduciaries, created a lot more value for their clients than what they actually were taking from them. But they were in the minority in the industry, only representing roughly 30% of transactions or so, while 70+% of the rest of those deals were being handled by part-time, casual agents that weren't very well experienced. And those agents, the ones I'm describing, those high volume committed ones, were already forming into teams and were already in effect running and operating their own business. Our insight, however, was, Tom, that they didn't own that business. They were investing the time, the money, the energy, the effort, taking all the risk, not getting any of the equity upside, in the way that if you're a merchant on eBay or on Amazon, you can use that platform to distribute your product and make money, but you're not really building any equity because the distribution and the brand and destination and all of the infrastructure and so forth, and the consumer relationship, the customer relationship, is actually owned by those platforms and not by you. So we said, let's take more of a Shopify approach to real estate and take all of these folks who are running a company and put them in a position where they can actually own that company without having to operate a brokerage from scratch.
I think that's fantastic. And for people that may not be familiar with real estate, if you're listening right now to what we're talking about, think of it this way. Is if you've ever seen on Amazon, someone wrote a book, like self-publishing platform. They're starting at zero. No one has bought the book yet. They may be an expert on something, but now they're putting it in a book and there's been no copy sold. Nothing has happened yet. And so Amazon self-publishing allows them to get off and running. What Guy is talking about, think about an author that's built an entire business and they have customers, they have everything going, and yet now that it's built, everybody around them has made money on them fair and square. But from that moment forward, why shouldn't the author get a bigger cut? The publishers have made money when they were a young author, didn't have it. And the same way, I think he's talking about, you've got real estate agents that cut their teeth, get up and going, building relationships. 10 years into it, now they've got a business running with their clientele. The house has made money fair and square up to that point. But from that point forward, why shouldn't they have their own office, their own business, and get the fruits of that and also be the equity participant in that? And that's what I thought was so exciting about what you did.
It's exactly right. A great real estate agent is an entrepreneur first. They wake up every single morning and connect invisible dots that no one is telling them how to approach. There's no instructions to it at all whatsoever. They put up the time, they put up the money, they take on salaries, they employ people, they manage, they help other agents become better at what they do, they mentor. But in the traditional status quo relationship between agent and brokerage, where an agent legally has to be affiliated in order to sell, help buyers and sellers, they don't get any of the equity upside. So our message to those agents when we started Side was, hey, now you can take your own advice for the first time. You can, instead of renting, you can buy, and Side will come in and help you make the down payment.
There you go.
So you don't have to figure out how to actually build a brokerage.
That's fantastic. You know, on Patrick Bet-David's podcast, I'll cover a lot of market stats and I give people down to earth, feedback. And one of the things we've been covering is what's been going on in the real estate market today. So the real estate market may be way down in terms of number of transactions, but it's not zero. It hasn't gone to zero. It's gone down. Interest rates may be up. At right now, I think 7.5%, maybe a little bit down. I mean, a week ago, like 7.875, 30-year fixed on a $700,000 mortgage. I think that came down about 0.5 point this week. There's a little bit of relief there. But what's interesting is that doesn't mean nothing's happening in the industry. Sure, if you're a mortgage broker, maybe the refi market is dead right now, because how do you refi from a 4% that you got 2 years ago into a 7%? That's not good for anybody but the bank. No one's going to do that. So the refi market's out, but there's still transactions happening. How are things going for Side? Because a lot of what you work with potentially is realtors working with cash buyers and working with high end. What do you see the market in America? Because all this bad news is out there. There's got to be entrepreneurs that are focusing, refusing to give up, that are still making it even in this market.
The real estate market in the US is incredibly robust and durable and healthy. This correction is very different than the housing crisis in that the mortgages are sound, and I think it's something in the ballpark of 40% of people who own homes in the US today don't even have a mortgage on them. Right. And the rest of those that do have refied into very low rates that they are locked into. And that's what's creating a supply constraint in the real estate market, in the housing market. The problems are not born out of a lack of demand. The higher interest rates have done very little to dampen buyer demand for homes. What they've done more so is constrain the ability of sellers, or the incentive for sellers, to actually bring their homes to market in the first place.
Got it. So people aren't stepping up in a community, because if they want to step up to something and they've done well in life and maybe they run a business or something, they've recovered from COVID and all that, stepping up is harder, because you do have to give up that lower interest rate, and the step up may be not just a little step up, a lot, because of the payment.
Exactly.
And so we have a supply problem, not a demand problem in the U.S., you're saying?
That's exactly right. When homes come to market, for the most part, with some exception, but for the most part, there's still multiple offer scenarios. They're still on market, much less than 3 months on average. It's trading, it's moving, and it's liquid. The constraint is on the supply side, not on the buy side. Instead of doing the traditional upgrading up by buying into a new home, people now are just refinancing out or taking a HELOC or have money in the bank already and are renovating into the home they already own.
There you go. So who were you before you founded Side? What were you doing? What was your experience? There's a lot of people that watch our programming here at Valuetainment, and they have an idea and they want to step out as an entrepreneur, we always give them the same advice. Make sure you've saved some money to get out there and make sure you know the market, you know the buyer, and you are smart about whatever it is you're going to do, whether it's software, whether you're making t-shirts in Berlin, doesn't matter. Make sure that you're ready to get through the winter with some savings. And they all come from different places, but what they all love talking to each other and learning what everybody's background, what was the fingerprint of the entrepreneur before they started the successful company that kind of defines them. What were you doing and who were you?
I don't come from real estate, and if I had been in real estate, the odds of us having thought of side and having had that insight would have been much lower, because more often than not, when it comes to legacy industries like real estate or hotels or taxis, it takes an outside perspective and a beginner's mindset to identify the opportunity that everyone else within the industry is missing, because they are so institutionalized and are so invested in the status quo that it's really hard to see beyond that. The way I describe it is like a fish doesn't know that land exists, right?
Exactly. So what were you doing? So what were you
water.
doing when you looked out at real estate and you said, I think there may be an opportunity over there, but you weren't tucked in real estate and kind of stuck,
I was not.
in your views?
I for whatever reason, came out of the womb helper, compulsive helper, and a problem solver. I see a problem, I want to fix a problem, just am drawn to things that way for whatever reason. I like to hold doors open for strangers. We can psychoanalyze it all we'd like, but it just is what it is. And I started my first company in college by accident, and many years later found myself in, and it was in reaction to a problem I was having. I had an itch, I went ahead and scratched, and next thing you know, I was scratching for others. And many, many years later, when I was in my early 30s, which is about 8 or 9 years ago now, I found myself in this incredibly privileged position where, for the first time in my life, I had enough money in my bank account that I didn't have to work to make ends meet every single month. And that allowed me to buy myself some time to be really deliberate about what I wanted to do with the next 20 years of my life. My 20s were all about exploration, and I let the wind take me where it would, without trying to control the direction. And in my 30s, it was all about being a lot more deliberate. And so I actually went through a 2-year process in my early 30s, searching for a really compelling problem to solve that would enrich and support and be of service to people I actually deeply cared about. And I did not think that would be real estate. And it wasn't until 10 months into that nearly 2-year period where real estate presented as an opportunity. But I was just following the problems. I took away all the solution bias. I wasn't going out there looking for a problem to solve with a particular solution in mind.
That's fantastic. Do you today, or at the time it was founded, did you have like a key advisor or maybe a mentor? I had a mentor all the way up into my 40s, somebody I could trust and go talk to. I never thought of mentorship as something, I need it because I'm green, I'm right out of college. But I always had somebody there. Did you have somebody in your life that was a key advisor or a mentor you could go to bounce things off of? And where did you find that person?
I'll say a few things on that. I think fundamentally for entrepreneurs watching this, one of the most important things you need to learn how to do as an entrepreneur, as a founder, is to manage your own psychology, to be your own mentor, and to become someone that understands how to be introspective and intellectually honest and sober about what's real and what isn't. And that allows you to be more objective and make much better decisions. And that has been what sustained me, that ability, much more than anything else that's external, is just that internal dialogue and that internal capacity. But there's no question that in my life, there have been a lot of influential people. The closest I would say that comes to a mentor is a gentleman named Dana, who is with one of the world's best venture funds, called Matrix. It's been around since the 80s, long before the movies. Very successful, early stage fund. And I met him unceremoniously when I was in Los Angeles working on my previous company, and we established a connection relationship that was just there for some reason. And for many years, we stayed in touch. And when I decided in my early 30s to go off and explore and figure out what to work on next, he was the most supportive person in my life, made himself really available to bounce ideas back and forth, and eventually actually financially supported the mission of Side and made it possible for us to come to market.
Fantastic. You know what's interesting? Managerial psychology is such an important point, because I think there's a lesson in there, Guy, that you're talking about is you might be able to have too many advisors, or you might be trusting people that maybe are different risk profile people. Yes. Maybe they're more corporate, and so they're going to be, hey, you've made this money, it's sitting in the bank. Why don't you just go work for somebody else? Why take that risk? And that's the wrong psychology. If you really feel you have found something, you can follow it. You believe that there's an itch to scratch there.
I would add, two quick things to that. One, I don't believe that you should go out and seek mentorship or seek mentors. And oftentimes you'll find your best mentors in your peers, people that are also doing what you were doing, working in the same stage, or maybe a little bit ahead of yourself. But mentors will present themselves as an output of your efforts, your motivation, your commitment, and dedication. If you put your shoulder to work on solving the problem that the people you want to solve problems for need solved, everything else tends to fall in line and follow. You don't have to engineer it or manufacture it. I do think there's a lot of value, Tom, in preventing your thinking from becoming overly influenced by inviting too many outside opinions from every person you can possibly imagine or muster. There's a great deal of value in allowing yourself to have inspired thinking born out of your own reason, right?
Yep. I think we're going to pull that as a short clip, and people are going to see that over and over. I happen to 100% agree with you. One of the things that I found with my companies was the importance of transparency in the face of mistakes. We didn't make a lot of mistakes, but sometimes a mistake would be made, or you misjudge a market, but you had to guess, and your guess was wrong. Had there been any mistakes or things with Side, not something cataclysmic that almost killed the company, but just key mistakes where you have to sit back and go, you know what, that didn't work, we can't do that anymore? If there was something like that, you don't have to go into it, but how transparent were you about your role in it with your team?
All very good questions. I was thinking about this question a bit proactively because you mentioned it to me ahead of time, because you knew it would be a bit of a hairy one, but I couldn't actually, I could say with a fair deal of confidence and conviction that Side hasn't experienced or made any one big mistake. I don't know if that's a real thing where companies make a single big mistake. I think what the only single big mistake you can really make is preventing your company and yourself from having an opportunity to make the day-to-day, week-to-week small mistakes that inevitably you will make in the course of bringing something new to market, commercializing, selling, executing. So the only real big mistake you can make out there is if you've got an idea and you maybe are, go out and try to build it to perfection, and you take a year before you put it in front of a customer. And then once you do, they immediately react to it and say, oh, I wish it had this thing. And you could have known that 11 months beforehand if you exposed it more upfront and allowed yourself to have more cycles to learn from the mistakes that you're making and then apply them. So that's the only big mistake you can make, and I'm very fortunate to say that that wasn't the case at Side. And it's because I've had enough experiences in the past where I recognize that there's great value in making mistakes and making it, normalizing it such that people can make mistakes and not suffer, consequence or something overly punitive is an incredibly important, forced to have within a dynamic organization and workforce. So I often tell the team, you're more likely to die from indigestion than starvation. We're more likely to die from 1,000 little cuts than one big giant one. And so one of my go-to tenets is that success is almost always in the recovery. It's in actually making progress, anticipating that there'll be some misstep, knowing that you can't anticipate each and every one of those, but being prepared to react when they happen.
That's outstanding. Well, I really appreciate you taking time to be here. This has been really, really rich. I'll give you the last bit. Are there one or two pieces of advice? And I know you said don't seek mentors, but is there one or two pieces of advice to entrepreneurs? How about if you know one of them from the early stage, but one of them like more mid-stage? You got off the ground, you have your second or third venture capital, you proved your model, you're making some revenue, so you have validation. Do you have some advice for either that early stage entrepreneur or the mid-stage entrepreneur? Because you've been very successful along this, and you've done what most people dream about doing, is you've got the $1 billion valuation and a proven business model and momentum. It's up to the market and everything else to be ready to see how high you can go.
Exactly right. My advice for early stage, if I had to impart one thing, if you're just in the beginning of solving problems and building software or service or whatever it is you're doing, is pay very close attention to the quote unquote frequency case, the frequency case. That's what you ultimately want to solve for. So, for example, if there's going to Africa on a safari is very low frequency, right? That's not a behavior that happens very often for people. Getting on an airplane from one city to the other for work is a much more frequent experience. So if you're building something in travel, your best bet is to identify the problems around the frequency case where there's lots of activity all the time, quite often, because that's where you can actually get people to use your product or your service in a more consistent and ongoing way that creates retention long-term, which is where value really comes from. It doesn't come from the first sale. It comes from your ability to continue working with that person for many, many years to come. Right?
What a great point. The frequency case. Huge.
So I think in the early stage, it's a big old like secret sauce kind of thing, is find the frequency case. In Side's business, the frequency case in real estate is not a person buying a house. That only happens once every 10 years. Right? A lot of startups have been built around a buyer buying a house and making that easier. They've never done well because they have to originate a brand new client every single day to do brand new business. There is no repeatability, no consistency, etc. So that's what I would say. But Side's use case is smooth out the transaction process for agents. Agents are in transaction every single day. They write offers every single day. They put together listing agreements every single day. They handle addendums every single day. So making that really beautiful and smooth and magical creates stickiness and creates value. At a later stage, at a mid to later stage, I would tell you the number one piece of advice I would give people is founders and operators at that stage is resist the urge to hire into perceived opportunity. So resist the urge to hire into perceived opportunity. That's that indigestion versus starvation thing I was talking about. As companies become more successful, you have more capital, you start seeing opportunity everywhere because it is everywhere. There's opportunity everywhere. But to realize opportunity requires great focus, great investment, great energy. It's not as simple as turning a few people's attention to it. It's an incredible organizational lift. And so I think in mid-stage, the magical thing that you can do is be really disciplined about maintaining focus around your core product, going deeper, not broader, and making it that much more robust and effective.
Love it. Really appreciate that. Well, I just want to congratulate you and thank you again. I kind of, maybe love isn't the right word, but I really kind of fell in love with the company when I did the research to do the profile, the case study, because I looked at it and I'm like, wait a minute, this is not like these transaction companies. I call them real estate transaction companies. They're like saying, hey, put your house on the market. It won't cost you 6%. That's the only benefit. The only benefit you were going to save the seller, a percent. That was the only person in the ecosystem that gets benefit. The buyer didn't have someone to talk to. The buyer had to self-select and go through. And if they're moving to a new market and the neighborhoods are listed, what the hell do they know about the new neighborhoods unless they've actually gone to the city and driven around? And why would you drive around the entire city until you found you say, well, I think I want to live here. I think the school's here. That's what a buyer's real estate agent can cut all that time out of. And all these transaction companies were doing was making it easier for a seller to save money on the transaction. I looked at it and I said, where's the rest of the benefit here? Where's the rest of it? Where's the real estate agent that said, I was here 15 years ago when that housing division was built. It's one of the best builders in the area, right? And it's like, how would you know that?
Exactly. It really takes away all the nuance. And look, that's why 20 years into the internet, 90+% of transactions are still agent assisted because consumers genuinely value that. They want a fiduciary that knows what they're doing, that can cover their behind, right? Keep them safe, represent their interests, and that's why it persists. But yeah, I think I'll say a note on what you just said there, Tom. I know we were wrapping up, but I think very little innovation comes from cutting costs or making things cheaper, and very few companies have ever been successful doing that or pursuing that as a strategy. Real innovation is born out of creating more value than there was before.
It's a blue ocean strategy. It's like creating value and rather than discounting everything to become a bloody red ocean where all the sharks just attack each other. Well, thank you so much. I really appreciate you doing this. We're going to cut this into short clips. I hope they're useful to you too, to share with other people, because your story is a great one. And I so appreciate it. And I've, your friendship and knowing you, as well as giving your perspective to entrepreneurs everywhere.
Likewise, thank you so much for having me. I'm honored to be here. I've been a big fan of yours for some time. And like I said, when I first saw that video that you did describing what Side was, you were the very first person I ever saw that got it. So thanks for having me on.
Thank you so much. All right, I'm back and I found my board. So we're going to do a quick case study today in the spirit and the style of the old Biz Doc case studies. What I was just talking about is, hey, when you hire people, you may incentivize them. You may give them stock. Well, I've got a case study to talk about that through the lens of history of the birth of Inter Miami, the soccer team in Miami that just signed Messi, and the signing of Messi himself. Let's go back in history to see where it all starts. It actually starts 16 years ago in 2007. Wait a minute. Messi was born in 1987. He'd be barely 20 years old. How does Messi coming to Inter Miami go back 16, 17 years? I'll tell you how. David Beckham was coming to the LA Galaxy, one of the two Los Angeles soccer teams in MLS. At the time, it was one. He gets a 5-year, $250 million contract and has a clause in it, an option to pay $25 million in the future to get an expansion team. Why did they do that? They were trying to bring the wattage, the superpower, the superstar that was David Beckham, bend it like Beckham, to bring him to the United States to raise the characterization of MLS being a Tier 1 league, because it was seen as, well, when you get in semi-retirement, maybe some of the Europeans can just go off to the United States to MLS. No, they wanted to raise they did. Beckham, 5 years, $250 million with the Galaxy, and an option for $25 million to buy. Now, why is that significant? when an expansion team happens in professional sports, if you and me, wanted to go buy the expansion team, we would probably have to put up 9 figures, over $100 million, maybe $200 million to buy our seat at the table as an expansion team. Where does that money go? Well, some goes to the league, but the rest gets distributed to the rest of owners as a profit share because they have helped build the league to be something that you and I now want to spend $200 million for an expansion team. Well, he's being given a huge discount. So the Galaxy are paying him $5 million, 5 years, $250 million, but Major League Soccer says, and we'll help subsidize it. We'll say that in the future, if Beckham wants to bring people together for an expansion team, he only has to pay $25 million, not $100 million or more, whatever the price is at that time. Well, how'd that work out? We all know how it worked out. Beckham was a constant figure in United States news and media about sports and celebrity. Him and his wife, who was a popular musician, singer, and 2-time champion, the Galaxy, 2011, 2012. So it worked out. Beckham raises the stature of the league, and then in 2014, he exercises the option. Now remember, at the time he signed the contract in 2007, a young Messi was 20 years old and already being talked about as being the best player in the world. Well, now Beckham puts the option for the team. Inter Miami. It's pink. The pink follows the story. Let me shift this way and see what happened. So 2014, he exercises the option. I'm going to pay the $25 million. We're going to expand the team. Then he was joined by Marcelo Clare and Masayoshi-san from SoftBank Vision. Hey, if you know my case studies and I talk about venture capitalists and big funds around the world, you know the SoftBank Vision Fund and Masayoshi-san are players. Well, they were part of it as well. Well, what do you have to do once you have a team now? Now he's got permission to get a team. He's got to find a stadium. He starts working with the politics and city council and the planning commissions in Miami. Needed to find a place for a stadium. Well, there was one plan that you may have recalled. It was messy. Port of Miami. That got voted down. As a matter of fact, that got voted down 11-1. We don't want to do it. So they wanted Inter Miami. They wanted an MLS team, especially given the great diversity and interest in soccer, football in South Florida. Well, that gets knocked down. Well, let's put it in Little Havana, near the Miami Marlins Stadium. Nope, that gets knocked down, or not feasible. Then we'll put it in a place called Overton. If you look on the maps, you'll see where Overton is Miami. Nope, that doesn't work. So all of this is going on because between the time of the option, they're trying to get what is going to be the first year it actually plays in 2020. And he's got big money partners with him. Well, 2017, they even found even more money with the Moss family. And there's 2 gentlemen from the Moss family, brothers, that came and co-invested. And so there's an older brother, which was all part of he became the managing, I believe the managing owner of the team. And then co-ownership was David Beckham and Jose, the younger brother. They would eventually buy out Marcelo Clare, Masayoshi-san, and keep looking for the arena, a place to put the stadium, arena. I'm thinking basketball. So here we go. The 2020, the first year, 7 wins, 13 losses, 3 ties, 10th in the conference, 19th overall. Not bad for an expansion team. Not great, but not bad. 2021, the brothers, the Moss brothers, and RS Capital, a very large financial company, brings in $150 million and they buy out Marcelo Clare, Masayoshi-san. So the owners are now Beckham and the Moss brothers and RS Capital. Important thing, 2021, they're 12 wins, 17 losses, 5 draws, 11th in the conference, 20th in the league. Not great, but it's only their 2nd year of existence. But now there's a whole different style of conversation that is around Inter Miami. They're talking about bigger plans for a stadium, and Freedom Park would be the summation of those plans, which was a golf course that was right next to Miami International Airport that wasn't doing particularly well and also needed some cleanup. So this piece of property needed a lot of love. And to put a stadium there and to take time to do environmental cleanup and add other services like parks, practice fields, and things so the public has more than just a stadium to go see Inter Miami several times a year, that became it. The plans are fantastic. You can see here what we're talking about. The individual images you're seeing right now is Freedom Park, what it's going to look like. Then Beckham supposedly has been talking to Messi on and off for 2 years, dating back to 2021. And then July of this year, Messi is given an opportunity to come to Miami. But how did they win him over? How did they get him to do that? It's the same thing that they did that you would do if you have a small company and you need to get a technical partner. I want to hire a CTO. I want to hire a great sales leader. How do you do that? Well, you might give a little piece of equity in the company called stock options. Now they have to vest or earn them over a period of years, but nonetheless, you can afford to give them a salary. Maybe if it's a sales guy, you have an annual bonus and commissions. But then how do you get a real big player to come to you if you're small? And as you can see, this was the early years for Inter Miami. You do it with ownership. And they have given Messi ownership in the team. And I'm going to tell you what the senior owner said in just a minute, but let's reflect back. Does Beckham know a little something about the extra something to be in a contract? You bet, because he went to play for the Galaxy when he could have played anywhere in the world, and he was given a $25 million option so that he could buy the expansion team. Well, now Messi is being given equity so he could profit in the growth of the team that is Inter Miami. And check this out. George Mas, who is the older of the two brothers, he basically had an interview with CNBC and he said, look, last year we had about $56 million in total revenue, but we believe with Messi, with tickets and merchandise sales and everything else, that's going to double to $110 million this year. And right now, we're like the 10th or 11th most valuable team in soccer. You see the stats that come out once a year saying Dallas Cowboys, one of the most valuable sports franchises in the world. Yankees, one of the most valuable sports franchises. Well, check this out. Major League Soccer has also entered the conversation. The most valuable Major League Soccer team is actually the Los Angeles Football Club, LAFC. They just won the MLS championship, and they are projected having a value right now of about $1 billion. George Mas says, you give us a year with what Messi's going to bring to MLS and to Inter Miami, I believe we will be worth $1.5 billion, putting them as the most valuable MLS team. So you can see it leads to value. They believe Messi is going to lead to tremendous value of the team. And last night, we just saw it, their first game, it was a regional tournament that was put on. Messi scores in the 94th minute in extra time, hitting a free kick over the wall of players into the top corner of the goal, and the sold-out crowd at their temporary stadium while Freedom Park is being built goes nuts. MLS goes nuts. So on the first game, the realization of the star power and everything he wants to be is here. And there's where it goes for you and me. Do you see how the puzzle can unfold over many years? That's the case study. In your industry, what you're doing, the puzzle can unfold for you, and a key player that you bring in, giving a little equity into the company, can be something that helps drive the value. That's what's happening here. So what's happening here on a much smaller basis can happen to entrepreneurs, and leaders all around the world, whatever you're doing. As I like to say, whether you're running a t-shirt company in Berlin or you're running a technology company in Silicon Valley, this is what happened to you. And this is the story of Inter Miami that really started back in 2007, and it ends today, chapter 1, with Messi joining the team. And in 2025, his third year of the team, they will be kicking off at a brand new stadium that I predict people are going to be saying, the house that Messi built. That's the case study for this week, and that's the lesson for you and me. We can find the Messis for our company, not on the scale and in the headlines, but the people need to bring on, and we can use a little bit of equity to sweeten the pot to ensure they do. Let's get back to the studio. Businesses today are facing a rough world. The stock market is angry. Federal legislation is sending taxes down, threatening to wipe out value. It's just a very, very tough time. As an investor, where do you turn and what do you do? I think precious metals is a great alternative. Businesses today are facing a rough world. The stock market is in an angry mood, as is the economy. Banks are failing. Inflation is never ending. And a looming recession threatens to wipe out stock value. That's bad for business, but even worse for retirement funds, especially if you're the one getting ready to retire. And to make things worse, the government is targeting those retirement funds, your 401ks and your IRAs, with heavy new taxes to pay for things like social justice agendas and federal deficits. The good news is that there is a way to help protect your financial future: investing in precious metals. American Hartford Gold will ship physical gold and silver directly to your door. Or they can set you up with a gold IRA, where you can invest in gold that shows up in your IRA. The gold IRA can shield your wealth from this economic meltdown, and the best part is this method is tax and penalty free. That's right. Analysts predict that gold is set to hit all-time highs. If you have retirement funds that you cannot afford to lose, now is the time to call a precious metal dealer. And here is the only precious metal dealer that I, the Biz Doc, currently trust: American Hartford Gold. They'll show you how to protect your savings and retirement accounts by diversifying your portfolio from stocks, mutual funds, and other things with physical gold and silver. With the finest products, fantastic customer service, and a buyback commitment, American Hartford Gold has earned a 5-star rating from thousands of reviews and an A+ from the Better Business Bureau. Tell them the Biz Doc sent you, and they'll give you up to $5,000 of free silver on your first order. Click the link in the description below or call 866-535-0767. Again, on your screen, 866-535-0767, or just text BIZ, B-I-Z, to 65532. Well, interesting story about Inter Miami. I hope that was helpful for you. I'm Tom Ellsworth, the Biz Doc, and I hope I left you better than we found you this week with everything that we brought this week's podcast. But there's something more that we'd like to offer you, and that is an opportunity to improve your business by getting shoulder to shoulder with a lot of entrepreneurs just like you, and hearing from Patrick Bet-David and a lot of the staff from Valuetainment, as well as these incredible speakers at the Vault Conference. It's August 30th to September 2nd, right down here in Fort Lauderdale. It's actually Hollywood, Florida, which is right by Fort Lauderdale Airport on the coast here. And here's the folks that are going to be there. First, you got Patrick Bet-David, the founder of Valuetainment, founder of PHP Agency, author, entrepreneur, everything that he's done. And then also we have there's Tom Brady going to be talking about leadership and building championships with different mixes of people. The same thing that you have to do as we go through the different people that'll be at our companies. We have to keep rebuilding our success. Also be there Mike Tyson talking about never get in the ring without a battle plan, which is great. And he's a fun interview to listen to. And then Will Guidara, who took a restaurant in New York all the way to the #1 rated Michelin restaurant in the world, and he will be talking about building the team, setting the North Star, and everything. He's there, and set with a great interview with Patrick. The Vault, go check it out, www.valuetainment.com, and go to the storefront and find that. And then we also have Kellyanne. We have a what is the URL just for the Vault Conference?
www.thevaultconference.com.
Fantastic. We look forward to seeing you there, and we'll see you next week on the Biz Doc Podcast. And until then, I'm Tom Ellsworth, the Biz Doc, and I hope I left you better than I found you.